What's going on, folks? Welcome to TTI Weekly Roundup, Friday, September 19th, 2025. My name is Hamilton. I'm joined here by our co-host, Randy. What's up, Randy?
Hey, how's it going?
For those of you that don't know Randy, he's recently joined our ranks. He was actually the co-host for the pre-FOMC Twitter Spaces, so if you recognize his voice, give him a shout out. And also, while I can, if I have your attention, folks, do me a favor and follow him on Twitter. He does some absolutely fantastic analytical work for us. He dives deep into the numbers, crunches numbers. He spits out these super detailed reports. If you're a part of TTI, you know what I'm talking about. Follow him over on Twitter at, is it ITM Randy?
Yep, that's it.
At ITM Randy. He's worth a follow. Okay, so as we get into kind of this TTI Weekly Roundup, I actually want to yield back a little bit and ask Randy, hot shot question here. You had no time to prep. What is the best looking chart that has come out of this week?
Ooh, best looking chart. I have to say,
I'll pull it up when you
I
say
just
it.
okay. I this morning I was just looking at ARC and comparing that to the Nasdaq. There's really a lot of good charts. You've got the total three with crypto, and then you've also got the ARC performance. I really like ARC because this sets the narrative and the tone on what we can expect going forward. ARC has some of the most high beta, most cyclical names within the ETF, and this thing has just been on a rampage. It's not anywhere near the all-time highs. It's got a lot of catching up to do, but when you think about the names that are within this ETF and the makeup uh, of the ETF, I mean, seeing such a high momentum reading is really encouraging and really sets the tone for the next 3 to 6 months, I think.
100% agreed. So let's dissect this idea because I think you're right on. It's bigger than ARC, but ARC is absolutely a piece of the puzzle. It's bigger than any one individual chart, and we can build on this idea. It's the fact that the market is willing to own the riskiest, highest beta areas right now post FOMC decision. Now, you could argue that they've wanted to own them for the last couple of weeks. As a matter of fact, if you're on the free newsletter, hint, hint, if you're not, go sign up. I send out one per day. I posted this chart there on the free newsletter side. Small caps are leading higher off of the August 11th post that we made. We had a little powwow as a group. And we said, listen, we think small caps are going to have a good opportunity to squeeze higher. We were doing some ratio work, et cetera. And lo and behold, going back to August 11th, IWM has outperformed the Qs, the S&P, silver, and gold. So yes, small caps are running. You can make the argument that the market's wanted these for a while. But look at total three you mentioned, right? It's the total crypto market cap without Bitcoin and Ethereum being represented. Then you look at ARC, and you can look at not only ARKK, but I would assume, I haven't looked at these yet, but ARKF looks good, yeah. ARKF, ARKX, which is your space and exploration. I mean, these are pushing into all-time highs. And we own these components. The bigger idea here, as you eloquently stated at the end, is that risk needs to be pressed for the next 3 to 6 months. Everything is firing across the board right now. We got the positive confirmation in the R2K yesterday. It's hard to argue against owning, the higher beta trash stock, small cap stuff that nobody wants to own, and yet it's the stuff that's outperforming right now.
Yeah, exactly. I mean, just look at any screener and look at the ETFs and the makeup of the stocks that are at all-time highs,
Let's
right?
do
You've
that
got
really quick. Watch this. Let me throw up, go ahead and keep talking, but for those of you watching, I'm throwing up ARC, the holdings of ARC. I want you to look at the components in here and just think about what they represent. I don't care if you like them or not, but the idea of the company as a trading vehicle, what do they represent? Go ahead, Randy.
Right, you've got ARC, you've got technology, you've got semiconductors, you have small caps, which is a big one we've been hitting on inside of TTI. I mean, 52-week highs matter. There's huge institutions, retail investors that anchor around 52-week highs or all-time highs for that fact, or 50-day highs. Generally, the longer the context, the better the overall signal. So that's why 52-week highs are so powerful. But you're seeing a lot of these highly cyclical risk-on names. And that's just not something that you get whenever you're concerned about a market that's positioned itself to be bearish or defensive over the next 3 to 6 months. So there's really a lot of highly cyclical groups that are trading at all-time highs or 52-week highs, and that's just a broader signal for the market in general.
You're absolutely right. Let me take a step back because it's easy to say that now, and that's not a slight at you because we're on the same page. But let's say, 3 weeks ago the market was churning sideways. People were talking about tech being over. The semi-trade was over. Remember that garbage? People on Twitter. Oh, what happens if this Head and Shoulders complete? This stupid stuff. People want to be bearish. They're going to find a reason to be bearish. We did not get bearish ever. And one of the big reasons why was exactly what you just said. When the market prefers highly cyclical or offensively positioned stocks, right? Higher beta stocks, probably the end of the bull market is not here. And there's a couple different ways that we can look at that. We can look at something like an SPHB against SPLV. Let's throw that on the weekly and turn it into a line chart. What does this chart actually represent? It represents higher beta versus lower volatility, yes, but it's risk on versus risk off. If financial institutions are preferring to own higher beta stocks over lower volatility, can you really be bearish? And this is what, by the way, this was breaking out to all-time highs when the market was turning sideways, potentially about to break down. So we went through and we looked at all the different, we call these risk ratios and risk appetite indicators, but we went and we looked and we said, listen, are financial institutions selling off the good trading vehicles to hide away the defensive names? No, they were not. And obviously you can take it a step further. You can look at your equally weighted consumer discretionary against consumer staples. That was also pressing higher in through the consolidation and the slight drawdown. Again, you're thinking about, you have a couple bucks in your pocket, you're feeling good, where do you go spend it, versus you just lost your job but you still need to pay your bills, where are you going to buy groceries, right? That's the type of stocks this particular ratio represents. And the got a couple bucks and you want to go blow it because everything is great is leading the doomer consumer staples sector, right? So Randy's right on. What I'm trying to do here is prove to you guys that are watching this is that you don't need to wait for price to move on an absolute basis to start to build this thesis that maybe the end isn't here. What we did was we went and we just compared two different areas of the market, which represented completely opposite ideas of the market. One you would express if you were bullish, one you would express if you're bearish, and the bullish was winning.
Right, absolutely. And another one of the risk ratios that we look at is the Vanguard growth to Vanguard value. And that's pressing at all-time highs too. And the makeups of why these risk ratios are so important is because whenever you're thinking of things like a growth stock or things like a value stock, we don't look at fundamentals inside of TTI. We're clearly technically based traders. But we know that growth companies, growth stocks, tend to be more oriented on growing their revenues, growing their earnings, growing their free cash flows. And so the quality of a growth stock could be less than the quality of a value stock, because value stocks are more matured. They're companies that have been around for 2 million plus years, companies that pay dividends like Pepsi or Coca-Cola or Kroger or something like that. And these are slower moving names. I mean, that's what you would expect. So whenever you see a basket such as the Vanguard Growth Fund outperforming in an uptrend compared to the Vanguard Value Fund, I mean, that's just a very clear signal on where the sentiment is, right?
Yep, you can paint it a million different ways. We use Koifin all the time, and we're constantly looking at this particular relationship, growth versus value. We know that while we still can have a bull market with value leading, it's generally not a fun environment to be opening up a bunch of new trades. Sorry, energy guys, but when value leads, it just tends to be a choppier trading environment, even if we're still in an uptrend. What you really want to see is growth leading. Those are the better trading vehicles for the most part. And what we saw over the last quarter, you can go back over the last year to date, and dice this up however you want. But when the market bottomed on April 7th, we saw growth start to outperform value consistently, and that's what we've seen since then. And so once again, when things start to get tough, you need to be able to peel back the pages a little bit there and look underneath and go, okay, yeah, things might feel bad on an absolute basis, but on a relative basis, is this really something that I should be worried about? And one thing that we do inside of TTI, I think, as good as anybody, probably better than most people, is the fact that we're willing to buy weakness, but only if the overall bullish thesis is intact. And we use these risk ratios, as well as a bunch of others, by the way, to kind of come up with that plot. Are we still in buy mode, or should we actually be switching over to starting to sell everything, right? Really quick, I want to get into just some intermarket analysis here and look at a basket of stocks or assets, excuse me. And I think there's a little lag on the stream from where you're seeing this, Randy, right now. So you're probably not seeing the screen yet, but I'm just going to rapid fire off of these really quick. And I want your opinion on some of these. The Q's right now leading up 2% on the week. We'll see where that's at the end of the close, with QQEW up 1.57 and QQQ up 2.23. So we have both on an absolute basis and an equally weighted, or a non-equally weighted basis and an equally weighted basis, the Q's doing very well. Is that risk off?
The Q's doing very well on an equally weighted and just normal basis is not risk off. No.
It's I'm seeing that on Twitter. Well, okay, so I just want to dispel something. We yapped about it slightly pre-FOMC. A couple of weeks ago, people were screaming about breadth being terrible, and that was the reason why the market was going to fall. Randy, was breadth terrible? Is breadth terrible?
No.
It takes 32 seconds to pull up your own charts on TradingView and check this out. And yet people want to just follow whatever ideology they already have. If you want to be bearish, you're going to band together with the other bears and you're going to lose a bunch of money and you're going to be bitter about the world. That's fine. It's totally your prerogative if you want to do that. But for those of us that are here to make money, and you're worried about market breadth, QQEW is your equally weighted NASDAQ. And it looks like we're going to close at all-time highs this week. Is that bearish? I don't think so. Let's take it a step further. RSP, equally weighted S&P 500. We're up in towards all-time highs, not quite there. So let me throw you another question really quick, Randy. I know this is kind of rapid fire, but would you prefer the Qs lead the S&P or the S&P lead the Qs in a strong bull market?
Q's leading the S&P.
Give me like
100%.
a 15 to 20 second reason why.
Because the Qs, the underlyings that make up Qs are majority tech. Tech is where you have a lot of cyclical, a lot of risk-on names. This is the sector that is the most. It's a sector that's always growing the most in the market. Now, it doesn't have to lead every bull market, but generally when tech leads, you can really get some crazy outperformance. So both of them are fine, but I think I prefer the Qs leading over the S&P.
I mean, you're 100% right. When the Qs are leading, if you think about the makeup of the Qs, it's 50% tech, something like 30% cyclical, consumer discretionary, like 20% calm, something like that. Those are the big three, though, right? Tech, consumer discretionary, and communications, overwhelmingly tech weighted. And tech represents, I believe, roughly 30% of the S&P 500. So when the Qs are outperforming, you know automatically that this is a risk-on environment because the market is not going to go out and own tech, consumer discretionary, communications over things like utilities and staples and healthcare in a risk-off environment. It doesn't make any sense. When the market starts to roll over, or if the financial institutions and people that really dictate primary trend, when they start to get a feeling that, hey, things are about to shift, you're going to see that on a relative basis before you see that on an absolute basis. And what we're seeing here with the Qs outperforming the S&P 500 is that risk sentiment is alive and well. They want to own the strongest stuff in the markets, and they are. Once again, the Russell 2000 up into all-time highs, up 1.5%. Emerging markets are doing well. I mean, this has been a very, very good week for the most part for risk assets. I want to yield back 1 second and just get your general opinion. And I know you're not the crypto guy, but you are a crypto guy. I think everybody that trades nowadays is a crypto guy. What are your thoughts on the idea of crypto running once gold kind of simmers down a little bit? This is something that you and Mike were talking a lot about earlier this week, and I want to get your thoughts recorded, if you will.
Yeah, it actually makes sense. I didn't really understand the relationship until Mike pointed it out, but it does make sense that whenever gold starts to taper off, starts to consolidate, maybe it's not pressing into all-time highs. I mean, we've seen Bitcoin take these nice size moves, and crypto in general take these nice moves whenever gold sort of backs off. So the idea is that whenever one asset starts to lag the other, people just rotate funds and they just keep doing that. As far as crypto towards the year end, I saw an interesting chart that showed that whenever crypto is in a bull cycle, a lot of the gains tend to happen in the last quarter of the year, and I did not even know that. So we're just coming off of a breakout in gold that we've caught. Really nice breakout, might I add. But we're kind of approaching this extension level, this fib extension level. And if gold sees a nice pullback here, I don't doubt that Bitcoin can start the this leg higher.
Yep, I'm on board 100%. It's one thing that people need to understand is it's essentially the same trade. It's a global liquidity trade, gold, silver, the crypto market. I mean, all of this is an extension of the same trade. And we've done the work inside of TTI. We've crunched the numbers and we've noticed that there is a huge overperformance in Bitcoin against gold over a year-to-date performance when they're both running. I mean, Bitcoin is a higher beta asset, so as a trading vehicle, it should perform better. Also, it experiences way bigger declines. It's a higher beta asset. So, really quick, I want to give you a shout out on the gold trade. What percentage is that gold trade that you have on? I know that you were one of the earliest guys in the silver trade, and you added it on the gold trade. You want to share your percentages?
Oh yeah, with shares, I just own spot with silver. Not shares, just the underlying. But with gold, let me log in. Last time I checked, I was up 100%, but keep in mind this was a point 0.7 delta options contract,
Yeah.
which is not typically what TTI would do. But I thought that the breakout would occur. I just didn't think the magnitude would be so large. I looked at it earlier in the week, and if I went with a point 0.3 delta, it would have been up 300%. But I put 10% of my whole portfolio in this trade. So right now it's up about 80 to 90%, and that's at a point 0.7 delta.
Yeah, it's crazy.
So
It's
that
absolutely
would be
insane.
up. That would be up massive. Yeah.
I
I
mean, you
want
are
to
up
real
massive
quick
though. I think
before I.
that's a great trade. I just want to point that out. So don't feel bad about
Oh yeah.
yourself for choosing
Oh
to
yeah.
send it
Yeah.
out there.
Absolutely. I wanted to talk one more thing about breadth though, since we brought it up
Sure.
earlier. If you look at the S&P 1500, so this is literally 1,000 more stocks than the S&P 500. The ticker is SPTM. You got this thing at all-time highs. So there's like a lot of confusion with this whole breadth work, and the bearish side that I'm seeing from it comes from people that are looking at like comparing the stuff to the moving averages, like what's above the 20 or below the 20. First off, 20 is way too short for any sort of secular trend shift that you're going to want to potentially see. But also, you can have stocks that are trading near all-time highs, but are below their 20-day moving average or 50-day moving average if they're consolidating, right?
Yep. Yes.
So I don't think that's the best breadth measure, but something like the equally weighted S&Ps, equally weighted Qs, or something even broader like the S&P 1500 gives you a really nice picture like, hey, there's more than 1,000 stocks in this ETF than the S&P 500, and this thing's also at all-time highs. And this is just not something you see all the time on Twitter because SPTM is not ever a trending ticker, so the impressions you get are pretty low with it.
So here's it. I just did this. It took me 15 seconds. You can get stocks above the 20-day moving average in the S&P 500, stocks above the 50-day, stocks above the 200-day. And as Randy stated, the 20-day is not enough information for a trend shift, folks. It's not enough. What it does do, though, is gives you a reasonable expectation for when you should be looking to buy more in a strong uptrend. Because when you see stocks pull back below their 20-day moving average, but remain above their 50-day moving average and above their 200-day moving average, those are buying opportunities. Those are not times to get bearish. You want the shorter term moving averages to oscillate at a faster rate. That's the whole point of them. The 50-day moving average, we have 56% of the S&P 500 trading above it. We have 60% of the S&P 500 above their 200-day moving average, and right now, we'll see where we close today, but right now we have 48% above the 20-day moving average. So prior to the FOMC, what it looked like was there was a little bit of a decision there, and then post FOMC, when we get the market closed today, we'll probably see these all ramp up and over 50, probably closer to all of them closer to 60, which is strong bull market territory. So again, folks, if you're worried about market breadth, we just showed you 5 different ways to look at it. You don't need to sit there and listen to Twitter guys anymore. Just go do it yourself. Right? Make your own decisions. By the way, I want to give a shout out really quick to the TTI clients because we've had an absolutely incredible week. I mean, seriously, we have a $200,000 win in A-Lab right now. Shout out Dustin. But we have been turning trades free all week. So yes, everybody was freaking out about the end of the world here. $60,000 win in RMBS, 50,000 in Micron. if you're focused on making money, there's opportunities to make money in the market. If you're focused on trying to outsmart the Fed and try to figure out what, Jay Powell's going to do in the FOMC statement and everything, feel free. You can get lost in the sauce all you want. But if you're here to make money, you're going to want to follow three simple things. And that's trend, relative strength, and momentum. And if you're able to do that, you're going to be able to make an absolute crap ton of money. So I think one of my favorite trades that we were able to turn free really quick is we turned Lyft. I know this is such a stupid trade, but I want to call out Lyft really quick. Lyft is, we opened this thing like 2 days prior to it turning 100%. I mean, look at this. We closed it on the 17th and we opened it on the 15th, I believe. And I mean, we just absolutely smoked this thing. I mean, look at this. I mean, very rarely do you get a January contract that turns free 2 days after you own it. So a beautiful stage 2 potential uptrend here. We'll see if we retest a bounce off the 21, gives us an opportunity to maybe add a little bit more here off of a basic resistance turn support bounce. But man, what a beautiful trade we were able to put on this. And all week, right? I mean, it's just been nonstop. There's weeks where nothing is happening. And then there's weeks where everything is happening. And this was one of those weeks where it just felt like everything was happening, money was flying everywhere, and we were able to capitalize on it. Is there one trade in particular that stood out for you this week that you want to highlight?
Oh man, I'd say the latest one was the whole quantum theme, the whole quantum space. I mean, I was able to get 300 and a little bit more percent off of playing QBTS.
Yes.
And a lot of the guys in the group just hopped on the quantum theme, and there wasn't anything too big with it. It was just like, hey, FOMC is going to come out. After it comes out, things will probably rip because it's less uncertainty in the market. There was a good chance that they were going to cut by 25 basis points. A lot of my work that I was doing was suggesting that, okay, this is not a time to be panicking. This is just a time to be buying. We hopped on some of these momentum names, and look at that. Look at those candles.
Yeah, it's insane.
I mean, I don't know what announcement came out of that, but
I don't think it was anything. I think,
TTI,
like you said, it was a total industry push. Now, I might
yeah,
be an idiot here because I haven't looked at these yet, but RGT, I'm assuming, yeah. So we've had positions in RGTI, we've had positions in QBTS. I mean, it's not one name in particular. It's a double faceted thing. It's one, like you said, there's less uncertainty, and the market knows now that we're reinstituting the rate cut cycle, which means these absolute shit companies are going to have a better chance of profitability because they're going to be able to service their debt at a hell of a lot cheaper, right? But then secondly, spec season is full on, right? Like, we know this, we can see this, and these are some of the most speculative names in the goddamn market. These are higher beta momentum based trades. Why are you not trying to take these when the market's hot? So yeah, you nailed this thing. I unfortunately am an asshole and missed it, but a bunch of the TTI guys grabbed it. So yeah, good job, man.
yeah. It's just, I mean, you were saying it earlier. Some weeks there's nothing that happens, and then this week there was just a ton. Last week too, really. I mean, we got the Tesla breakout too, and other plays. So this type of regime that we're in, this really high momentum regime, it's not the time to like sort of dilly dally and wait for the perfect setup. You just want to get in, man. Like, you just want to
Here's
get
a
in.
good example. Someone just called out on YouTube. One of the members there said, look at IO and Q. I mean, this was a trade that we put on back as it was retesting its 200-day moving average. And here we are. We got the $50 calls for October. This trade is up 1,000, I don't know, 1,000, over 1,000, I know. It might be 1,500% right now. But we grabbed these for about $2.30 a pop. 1,000%. That's not bad, folks. But it's like I said, it's the entire theme. And one way to think about this is don't get lost in or what is it? What's the beautiful quote? Don't miss the forest from the trees. Meaning, if there's one bad stock out there that you're focused on and it's not performing well, don't make the stupid decision that the entire market sucks just because that one stock sucks. We just showed 3 that ripped
Yep.
ripped in everybody's faces, and you're either in or you're on the outside looking at it because you can't get in now. I mean, you're along for the ride.
Yep, 100%. And it's not just the United States stock market too. Like, if you look at year to date, developed markets, emerging markets are absolutely ripping. In fact, those are beating the S&P, I think
We
nearly
can
by
look
a
at that.
factor of
Yeah.
2.
Yep.
You've also got China, which is a huge play that everybody on Twitter is on now. And we're in stuff like, I think we're in like a Singapore. I think Grab. We opened up Grab earlier this week. I think that's a stock from Singapore. The most random stock.
Yep.
But I mean, it's not just things in America that are working. You know, this is a very broad-based market.
I mean, to press that point even more, I know this looks like I just peeked on the screen here, but just the S&P 500 is up 13.5%. Look at the rest of the world, right? Like there's been plenty of opportunities around the world, and so what I'll very confidently get on my podium and tell you that the guys on Twitter that are telling you to raise cash, the guys on the podium that are telling you that a market crash is coming, these guys are fucking morons. I mean, it's been literally anything but that. As a matter of fact, if you were able to buy anything outside of the United States for the most part, you probably made a lot of money this year. And again, on the China stuff, we were patient with the China play, but we were able to grab a bunch of exposure in China relatively quickly. Like I said, there's weeks where you don't do anything, and then there's weeks where you do everything. And we had one of those weeks like 3 weeks ago where it was like, okay, time to get long China. And we opened like 4 or 5 trades up. And of those 4 or 5, I think 4 of them are already free. And so I think Baidu's was up 1,000%. Like, yeah, I mean, we opened up Baidu down here, and we got Baba, which is completely free for us. We just opened up, or are opening up BILI. We got KC, and we got a bunch of this stuff here. So yeah, you're right. I mean, we're locked and loaded. This is a bull market. It's not just confined to the United States. It's the entire goddamn world.
Right. And I think the question here going forward into the year end is, okay, we've got this framework of the Fed cutting rates. We've got the alignment with the risk ratios. There's breadth in the market. So, I mean, you can have confidence going forward that, okay, this trend is going to persist. So, I think the question going forward is now where and what specific groups can I take the most advantage of the next leg higher? Because if the market's going to go up, let's say 5-6% year end, you can have a stock that goes 10%. Oh, okay, that's pretty good. But there's other stocks in other areas of the market that can get you up 20 or 30% just in the underlying alone. Okay, we're not even talking about the options contracts, right? So now going forward, it's figuring out which areas have the most juice to squeeze, right? I mean,
Yep.
that's what I feel like.
No, I mean, and options have just been able to allow us to essentially lever up our very bullish bias while capping our risk, right? We're not going to lose more than we paid for the goddamn premium, or we're not going to lose more than we pay for the position. And so why would we not take big bets in a strong bull market that is continuing to break out? The last chart I want to point out here, because you kind of let us in, is where do you think the juice is going to be? And here's my ballsy call that I've been on for the last couple of months. I think tech breaks out against the S&P 500 into all-time highs. We're back pressing up into the 2000 highs. You got a lot of bozos on Twitter screaming about the dot-com bubble. Listen, folks, for those of you that are old enough to remember what it was like trading from 95 to 2000, if you weren't long, you were wrong and you were poor. If you agree that we are in a dot-com bubble and you're looking to short the market, you are wrong and you will be poor. I'm willing to put that out there. I'm confident that tech breaks out against the S&P 500 above its 2000 highs, and this is the area you need to be long. I think when this goes, there's not going to be a lot of opportunity to get into some beautiful tech trades without taking on more risk and strong uptrends. I mean, you have an opportunity now to get in as it's about to break out. What you do with that information is completely up to you, but my focus is entirely on the tech sector and then the global macro trade, meaning precious metals and crypto. I think we lost Randy, but that's okay.
Oh, whoops. Here
There we go.
I'm back.
Is there parting words here as we step away?
No, I think you summed it up well. I think the big focus for me for the year end is going to be definitely in the tech space and crypto as well.
All right, folks. I appreciate you hanging out with Randy and I for our TTI Weekly Roundup. If you're a TTI member and you have any questions regarding anything we went through, feel free to leave them as a comment below the video when we post it over on the Market Research Portal. And for those of you that are interested in our services, feel free to either send me a DM or sign up to the free newsletter. It's linked in the description or the bio, depending on where you look, and I'll send you all the information there. Randy, thanks so much. For the rest of you joining in, enjoy your weekend.